Okay, guys. Good day, everybody. I want to actually welcome everyone officially to this next video. It is Emmanuel, and should I say the Genie of TradeWise. So quickly, let's dive into what we're doing for today. We have a lot on the table, and yeah, I want to actually dive into it. So quickly, I want to actually touch on what we did on the last video. Now, first, I want to make you understand that yeah, I'm not going to be treating things or touching terms as rigid as they are, or should I say as literal as they are, so that you don't get so overloaded with so many informations, because there are so many times we're going to be covering in this very class. But I want you guys to actually have a very simple understanding of each and every one of them, so that you are not so overloaded with so many informations. But if you are the type that loves cramping yourself or having your heads loaded with information, then feel free to hit up YouTube's, Google up some of the terms we have used, and you should get more information from different other sources. Now, with that, I want to start this very class with a psychology talk, and what I want to discuss today is expectations versus reality. Now, majority of people actually come into trading with the idea that they can actually make money overnight. Now, some people come into the market with the idea that they can actually turn their $100 into $100,000. Yes, it's actually possible, but if you are looking to do that in less than a month, or in less than 3 months, or in less than 6 months, depending on your level of expertise, your level of expertise and your level of skill in the market, then depending on even your trading plan as well and the strategy with which you trade, then you have a possibility of failing. It's not a probability, it's a possibility, something that would most likely happen. Now, what is a possibility for every trader? What is reality for a trader? Trading is hard at the very starting stages, but for as long as you have a working strategy that gives you an edge in the market, and you have built a system around it so as to remain profitable for as long as you trade with it, then you would always make money. Not find a way to make money, you would always make money, because you have you have a strategy that is process driven, or should I say a system that is process driven and has an edge in the market. By having an edge, we mean that you have a trading strategy that ensures, let's say we have a trading strategy where we trade with 2:1 risk to reward, meaning that whenever I lose $1. Whenever I win $2. If I have an edge of 60%, it means that whenever I take 4 losses, I will always have 6 wins. So automatically, whenever I take -4, I win +12. Mind you, each win is 2. So 2 times 6, that would be roughly 12 plus 12. Now, that gives me an edge, because now I've lost 4 and I've won 12. Automatically, I'll be up by 8. And in a case where I have 40% win rate, and my risk to reward is 1:3, meaning when I risk 1, I'm aiming to make $3. Now, if I lose six times out of 10, that is 60% out of 100%. If I lose 6 out of 10, I'll be losing $44. But since I'm making 3 on each one I win, so if I lose 6, it's $6, right? Now I'm making 3 in every one win. And mind you, I'm winning just 4 times. 4 times would give me roughly $12, and I would have made about $6 extra in gain above my loss. Mind you, let's go back to 2:1. Say I'm getting just $2 per $1 risk. In a case where I am actually risking, I lose 6, I have lost $6. If I win 4, 2 times 4 is 8. You are still up by $2. You see that all you need is a strategy that gives you profits. You don't have to make the whole world. Eventually you will. He that makes $2 every day would make roughly $60. There are 20 trading days, so you would make $40 in your first trading month. If you are trading with a capital of $50 and you are able to make $2 daily, you would make $40. Your total capital would have gone up to $90. In the next month, you should be able to make like $3 to $4. With $4 as a quota, you would be able to raise that very account from $90 to 170. That is in month 2. In month 2, your gain would move from $4 to $8. Let's say you do $7 just to be on not the too risky side, and you are not making $7 daily for 20 days. You would have made 140. Your current capital would have gone from 170 to 310, I believe. And with 310 in your this is your third month, right? Now, in the third month, with 310 as a starting balance, you should be able to actually, wait, $50 was first month, second month gave us $90. I think I'm actually making a mistake somewhere. $90 second month, 170 third month, fourth month we have 300. Okay, now in the fifth month, you are now making roughly $115 on a daily. Now you can actually bank $300 done in 1 month, and now your account has gone up to 600. Mind you, we started this whole journey with just 50, and in 5 months we have taken it up to 600. In our 6th month, if we are able to make $30 on a daily basis for 30 days, it's going to give us 600. So 600 plus 660, let's say you decided to withdraw 60 and you have just 600 as your balance. Now, plus $600 done as a capital gain, as a gain, you would have 1,200. If we should continue this process for 2 years, or should I say 3 years, maintaining the system and not getting greedy, maintaining the system and not skipping the process, remaining disciplined every morning and every time we come on the chart, I tell you that in the next 10 years, you should be trading nothing less than $100,000. Feel free to do your calculation. I'm sure it should be more than that, but feel free to calculate. We were able to take $50 to 1,200 within 6 months. So tell me, is it not possible to take that very account from that amount to 100,000 in 10 years? Feel free to do your calculations and drop your answers for me. Now, what am I saying? Expectations to reality, please. Whether you like it or not, whether you are in a hurry or not, you are going to be successful as a trader. But the reason why we have a large number of failing traders is because everybody is in a hurry, including me. I was in a hurry, so much in a hurry that I moved from making over $100 to $200 every month as a trader to owing over $3,000, because I was so much in a hurry that I decided to go take a loan because I wanted to make it big. I was so much in a hurry, and this is one of the reasons why I actually started TradeWise Academy, so as to help others not make the same mistakes that we made when we were starting, so that you don't fall into the traps that we fell into because of we were so much in a hurry instead of facing reality. Mind you, you're going to be successful, but if you try to skip the process and go too fast, you would end up hurting yourself, hurting your account balance, hurting your bank account, hurting your family, your loved ones. Because I tell you, when by the time you start taking so much losing streaks, losing money and losing money and losing money and losing money, it's going to turn you to an angry personality. It's going to frustrate you mentally, physically, financially, emotionally, spiritually, and every other surely there's any other thing that has LLY. I don't really know for you. So really work on your expectations. Don't say I have started Forex, I'm going to make 10 million. You might, but please don't go hoping to the extent that you start skipping the process, that you start jumping in what we're teaching, and then you say this thing Mr. Easy is teaching is not working. I want to make money so fast, so I'm going to stop here and go look for my destiny elsewhere. Please don't skip the process. Face reality. Face reality. For you to actually be successful in reality, in real time, for you to be successful, it takes a lot of work. So don't skip the work. Don't skip the work. Now let's dive into what we have for today. I feel we have taken so much long on this. We'll be looking first at trading mates. Number one, we have the 90-90-90 rule. which is 90% of traders lose 90% of their capital in their first 90 days of trading. I wanted to touch this. Like I said, this was going to be a psychology session, and then I'm going to touch one or two things. Mind you, we're actually just kickstarting the class. So I wanted us to know a few things before we actually start looking at theoretical class. We'll start doing more of on chart workings from probably the next 2 weeks, I believe, or the next 3 weeks. So 1990 rule, 90 rule. 90% of traders lose 90% of their capital in the first 90 days of trading. This is because majority of traders that actually come into trading come in with very little capital. That is number one. Number two, some come in with very little knowledge of the forex market, of how to trade. Some come in without a trading strategy. Some just go on YouTube and they Google a strategy. Now they forget that it's just a strategy. There is a system needed to actually be successful. The strategy is only a part of the system. Okay, so the strategy is the part of the system, and people just go on YouTube, they get strategies, and they just feel they can be successful with it on chart. But for as long as you don't have the full system, the full pieces to that very chess board, you are going to fail. So this is one of the reasons why people actually fail. Now, another thing I feel that causes this is because majority of traders lack the right emotions to manage certain amounts of capitals. There is a level of emotion that is needed to manage a very small capital. A very small capital, you need to be very good at managing risk, and you should be ready to risk it all. Why? Because it is very little. So there is nothing much to protect. Okay? And then, because let's say you're trading a $10 account, or let's use a $100 account. The least you can enter is a 0.01, and if that 0.01 goes against you for 20 pips, you've lost 2%. You can't cut your risk halfway, because that you're already at the lowest amount possible for trading. But if you were trading a $10,000 and you were risking you are risking a 1%, which is $100. If you notice that the trade is not going your way, you can close halfway and lose just $10 in that trade, and you will say, yeah, I lost just 0.1%. It won't hurt you that bad because you didn't lose so much of a percentage from your account. Okay, so the right mindset, trading a small account, you should be ready to risk it all and not cry. But if you're not ready for that, then you are not ready to actually make money with a small account. Next, there is a strategy that turns you to a millionaire, known as the Holy Grail. This is the reason why most people are on YouTube looking for strategies. Some people are just in a hurry to make money. They are not here to be successful in trading. They are not here to make a living through trading. They just want to be rich. They want gold. They are looking for gold. So they are looking for a strategy that gives them easy money without them having to stress themselves. And I tell you, that strategy does not exist. There are good strategies on YouTube, but many people use them and still remain poor because those people are looking for quick money and they are not ready to follow the systems that are needed to be profitable with the said strategy that they found on YouTube. Moving on, you can make money overnight in trading. Yeah, you can if you have actually taken your time to study your system and you know how to follow your system right in the right manner. For as long as you are following your system, I'm telling you, you would make money overnight trading. Then finally, I don't know if this is the last one. Trading is a scam. That's a lie. It's a huge lie from the pit of hell, actually. Now, trading is as a game. Actually, I would say I can call that a game, depending on how you see it. But for me, I also see it as a business. It's a business, as a psychological business, and it's a business that majority of the smart fail in it. The majority of the smart people don't even succeed trading. That's because trading is so broad and is also so simple. So when people come into it and they just lose money so fast, they immediately brand it as a scam. They feel they have been shammed, they have been I don't know what word to use again, but their money has been taken from them by force, and then they forget that nobody was holding their hand when they actually made the deposit. So bro, trading is literally the most legal thing anybody can go into, for as long as you have the right knowledge. For as long as you have the right knowledge, Those are not the Christ Embassy Church. I heard Pastor Chris Oyekundomi say trading, forex trading, he said it is a good business for as long as you undergo training. That was his recommendation. So please, it is important that you take training serious. Okay? Now let's go on types of traders. Now in this business there are so many type of traders. Okay, I'm gonna keep it as simple as I possibly can. The first people on the list are the scalpers. Now scalpers are traders that don't actually have so much time. These are the group of traders that don't want to actually spend so much time on the screen. Like, you can be someone that is working a 9 to 5 and you don't have so much time. Maybe you have just 30 minutes of lunch break. So these are those that want to come to the market, and in the next 15 to 30 minutes they are off. They don't want to be in the market for a very long time. So these people trade usually the 1 minute, 5 minutes, 15 minutes time frame. That is their field of business, and they can stay in the market for like 30 minutes, maximum 1 hour, 2 hours, and they are done for the day. These are scalpers. And then we have the next group of traders, which are the intraday traders. These are those that are willing to hold trades within the hours of 1 hour, 10, 15, 5, 15 minutes, straight up to probably 4, 8 hours, 12 hours, but they ensure they close their trades within the day. They don't allow it to hold on to the next day, so they close within that day. And this is actually this is actually where I fall in. I prefer trading max. I can take my trades in the morning, which is London section. Nigerian time is just so nice as it laps with that of the London. So I just wake up in the morning 7:30, I'm on the chart and I watch till 9:30. Then I enter a trade. If it goes my way, I can stay in it till 2, 3 o'clock, 4 o'clock. I close. I'm done. I'm not holding it for too long. I'm getting out at that moment. I don't care whatever is going to happen next. I'm just getting out at that very point in time. That is my closing time for the day. I should be off the charts. I shouldn't have any business taking any trades anymore. That is done for the day. That's me, an intraday trader. Their time frames for trading is 1 minute, 5 minutes, 15 minutes, 1 hour, maximum 4 hours. But the places they will place their trade is mainly on the 5 minutes and the 15 minutes. The scalpers are the 1 minute, the 5 minutes. Moving on, while the day traders. So day traders, basically these guys are those that are ready to take trades. I'll hold them for some days. So these guys can hold these trades for like 2, 3, 4 days up to weeks, as long as it takes. No, sorry, they should hold for days, straight up for days, maybe for like a week to 2 weeks maximum. These guys are the ones that trade the 1 hour time frame and 4 hour time frames. Then we have the swing traders. These are the guys that can actually hold trades for like 1 week, 2 weeks, 2 weeks to a month. I think I haven't heard of those that can hold trades for up to 2 months and 3 months. And these ones are the guys that can actually, these are the people that trade mainly the 1 hour, 4 hour daily time frame. That's their field of expertise. We can use those guys as our higher time frame, but these men don't use that as their higher time frame. They use the monthly, the yearly, the weekly time frames for their higher time frames. Why entries are done on the 1 hour and the 4 hour. Then okay, I actually forgot these guys. The range traders. Now these range traders are those that, these are traders that they usually don't have a particular time of day to trade. They stalk the market and they are watching for some very levels. So there are people that believes that whenever gold gets to 2,000 it must drop. So they are waiting for it at that point so they can spend the whole of the year without getting close to the market, and they're waiting for the very day that the market gets to that very price. And when it gets to that price, that's the day they come in, they can place a trade, and they are expecting it to move within from that place to a very long, they always have a very long amount of target and a long amount of stop loss. So they are much like a combination of the swing and the day trader for me though. And then we have the last people, which are the long-term investors. These are those guys that usually don't do so much of trading like us. These men can trade like once a year, once a month, once a month with even, yeah, once a month, and they can hold these trades for months, 3 4 5 6 7 it's 1 year, 2 years. They can hold it for that long, and they are very comfortable with their risk, very comfortable with their gains. They don't really care about the money. They are not in a hurry to make the money, and majority of them are the ones that have higher account balances. These are like the banks, and some other large firms. The market sections, very important. Number one is the London section, which is actually one of the most liquid, one of the most active sections, which starts at 7:30 a.m. I'm using the +1 GMT, which is the London time, and the same thing with the Nigerian time. Actually, this is actually Nigerian time to be precise. 7:30 a.m. to 5 p.m. Now the times I have here are from my head, so they shouldn't be like the best of the best, but I'm quite sure of that of London. And then New York session, this is 1300 and 2200. So now you would like remember when I said the market is very active at 1300. If any of you has watched the two YouTube videos I have on my YouTube channel, they are not for this class, they're just YouTube videos. You'll notice me saying the market is actually very, very active at 1300. The reason being that the London session is on and the New York session is on. So because they are interlapping and the two of them are the most liquid sessions, they are the time when markets moves very much volatile, very much liquid. Like there is enough liquidity in the market, enough money in the market to move it up and down. So because of that, the market is very active because two of these markets are on at the same time. You will notice the market will be quite fast, but not so fast from 7:30 to 12. But from 1300 on the dot, it actually increases in speed until 5 p.m. Then from 5 p.m., the moment London session actually closes off, the market gets slow again because now it's just New York on. And yeah, it actually continues that way. And then we'll move on to the third one, which is the Asian session. This is where I feel I might have some problems. I'm not so sure, but I know it should have started from 2000 to 2200 and will end around 8 a.m. in London. Now, I don't really care about this session because it has made me lose so much money that I don't like it. So this actual session is one of the sessions I would say you should avoid. The market is very indecisive at this very moment, doesn't have a particular direction, And then the last guy on the block is actually the Frankfurt session. This guy is just invisible. It happens during the 2300 to that is 11 o'clock p.m. towards the midnight hours, so it doesn't stay so long. I don't actually have the time for Frankfurt on my head. Feel free to google that as well, but it's quite invisible because it doesn't have any effect, so much effects on the market. I think it runs as well till the London section. So the Asian, the Frankfurt, and the London interlaps at around 7:30, which is one of the reasons why the market is also very volatile at 7:30, because we have three markets very active at that very point in time. I'm keeping things very short because I don't want this video to actually get very lengthy. We still have something else to actually discuss that's going to take much time, which is the chart breakdown. Okay, from here I feel we should just dive onto the chart. And yeah, and for this one I feel I'll be making use of the software I'll be using to place trades so that you guys can actually see what this. So yeah, this is what I feel I wanted to show you guys. So you see, when you come on your market, I think majority of you should have seen something like this. This is basically what the market looks like. This is called a line chart. We don't actually have any business with it, but it can actually help you if you are trying to mark up the lows where we have these edges. Are very important to mark out. These are where price. These are all strong areas that price will most likely want to retest later. Now, I don't usually trade with these guys anyway, so it's not that important. But this is called a line chart, and then we have another one which is known as the bar chart. It's known as the bar charts. Now I'll quickly explain what this guy is. Now when you look at this one, I'm going to dispose of this. When you look at this one, we're going to discuss candles later, but when you look at this candle, you see it has a line by the left and a line by the right, and then a strong straight line. Now the line by the left here is known as the open. This is where the candle started. Then this bottom low here is called the low, which is the lowest price it reached, it managed to get to. Sorry, I think that's actually obstructing the view of everything we're doing. And then the up here is known as the high, while this line here is known as the close. The high here is the highest price it was able to get to, while here we have the close. Okay, same thing applies when you come to candle mode. Now in this particular candle, we're using the same candle. This area here where this big body started, the rectangle started, is known as the open. That is where price started, where the candle started. This wick, this thin line is called a wick. This is called the body. This thin line is called the wick. So this lowest point on the wick here is called the low, and the highest point on the wick is called the high. The highest point on the body is called the close. Now a candle that starts at the opens at the bottom and closes at the top is called the bullish candle. Why in this case here, where we have a candle that opened at the top and closed off at the bottom here, this is called a bearish candle. Now you have the right to actually set the colors your candles take, and yeah, that's it. There are also different types of bars. As you check here, we have a Renko bar. I don't really want to implement that, but let's see if we can actually start that up. There is another one known as Heikin Ashi, is not here as well. I would have loved to show you guys what it looks like. And there are a number of traders that actually utilize most of these things to trade. But do we actually need them? I don't think so. What we will be trading for as long as this class session will be holding is just your candlestick chart, as you can see on the screen. That this is what we are going to be trading with and nothing else. This is the only chart you are ever going to see. Okay, so with that, I feel I've actually covered all I want to cover in this section. Next video should be coming as soon as possible. Yeah, that's the end for the video for today. See you guys on the next section, and feel free to drop questions on the WhatsApp